Hello everybody, this is AK. I'm back. So this video we are going to talk about how we could possibly get 9.5% dividend yield from a financial institution, a finance company. Right. Why settle for 6% dividend yield from DBS, OCBC or UOB? I mean 6% thereabout, when we can get 9.5% from another financial institution, right? That's 50% more dividend, right? So of course I'm talking about Yangzijiang Financial here, which was listed in Singapore not too long ago. I think it debuted at 69 cents per share, and today is something like 36 cents or 37 cents per share. Right, so the share price has plunged dramatically. Right, so Mr. Market doesn't seem to have much confidence in the company. I think that's understandable because Yangzijiang primarily has the exposure is primarily to the Chinese economy, and of course, when you're exposed to the Chinese economy, you cannot help but be exposed to the property sector, which has crashed. Right, and now the Chinese real estate is seen as the #1 source for the next global credit event amongst investors, surveyed by Bank of America. Right, and the ratio of investors concerned about China's housing sector more than doubled, right, from 15% to 33% in a global survey of fund managers. Right, so from those numbers alone, you can see why people are not touching Yangzijiang financial holdings, and they are keeping far away from it. Won't touch it with a 5-foot pole. Right, and Yangzijiang has been trying very hard to address concerns, and recently they did an FAQ, and I want to look at that FAQ now to see whether we could possibly invest in Yangzijiang for 9.5% dividend yield. This is AK talking to himself, please bear in mind. Right, so like I said, a big concern is with the real estate sector in China and how it has crashed. And Yangzijiang said that they have already made adequate provisions and they do not anticipate further provisions unless China's economy deteriorates significantly. Of course, what is considered adequate provision, we don't know. Right, the word adequate, right, means different things to different people. Right, whether they have to make further provisions or not, we don't know. If they make further provisions, of course that would hit their bottom line, right, because they would be recognizing some debt as being unrecoverable. Right, and they actually did say that if the Chinese economy were to rebound, then they would perform much better. However, if China's economy persists in a downward trend or deteriorates further, it will be difficult to expect better performance. And when asked to give more information about their exposure to the real estate sector, they said that the group exposure to China's property market was significant. And the debt investments related to property market falls into two categories. One where borrowers pledge their unencumbered land as collateral for funding, and the other where the group collaborates with real estate developers, with the group as preferred shareholder receiving fixed coupons, which means Yangzijiang Financial Holdings would receive fixed coupons from these real estate developers. Right, so when they say that, the image of Evergrande and Country Garden came to mind about how they couldn't pay the coupons to their bondholders, right? And that is scary, right? But Yangzijiang say that this second model operates within a closed loop and requires all decision making to be carried out under the supervision of Yangzijiang Financial Holdings, right? So they had some control. But in the event of a default, what happens will be the principal amount they say would remain secure. But losses on the project will definitely impact the group if the loss on that project surpasses the in-principle investment amount which was made. So I don't know why they say the principal investment remains secure, because in the next statement they say that if the value of the investment should be much lower at the time, then the loss on the project would surpass the principal investment. So that seems to me a huge risk factor, right? And I think this is reflected when they were asked if they could pay dividends twice or 4 times a year, like the Singapore banks. They say no, they'll stick to paying dividends only once a year, right? And when asked if they would increase the dividend payout to 50%, because Singapore banks have now increased their dividend payout, like OCBC confidently say that paying 50% of their earnings. Yang Zhejiang Financial Holdings say no, they're sticking to 40% payout. And the reason is because they say they optimize between growth and dividend payouts. I think that is pushing it. Because in terms of growth, I think they're having some real problem with the Chinese real estate sector. So if they could minimize losses or cut out and make sure they don't have any losses, that would already be a huge achievement in my mind. And the fact that they will stick to only 40% payout and they will only pay once a year shows that they are mindful of the risk that they are facing in the Chinese economy, and that they are actually being conservative, which isn't a bad thing. To their credit, that is a good thing, right? And so would I invest in Yang Zhejiang Financial Holdings? I don't see any reason to. Why would I want to take on greater risk and much greater risk just so that I can get some higher dividend yield in the short term? And that is not even guaranteed, because remember, if they have to make further provisions, or if they were to realize some of those losses in the real estate sector, the earnings will come down. If the earnings come down, and because they maintain their payout ratio at 40% of earnings, if earnings come down, their 40% payout ratio on an absolute dollar basis would also reduce, which means the yield that we see at 9.5% today might not be 9.5% in the future. So how much that's going to change, hard to tell. I would rather play it safe, right? So if AK can talk to himself, so can you. Bye-bye.